There's a range of misunderstandings. So some people think they're like cash, they're not. Some people think they're like bonds, they're not. And equally others would say they're like equities and they're not. They really are instruments that sit between equity and debt. I think that some folks think that they're also investments that only create problems if and only if the bank's going to blow up. That's partly true, but hybrids are extremely complex. In the bank and insurer hybrids that exist, there are normally two key clauses. The first is called a non-viability clause that allows APRA, the regulator, to convert the hybrid into equity in a stress event, or to write it off completely. And you need to be able to price that. You need to be able to value it. You need to think about what's the risk of APRA doing that, and then what sort of compensation do I need to take that risk. There's another key clause which is called a capital trigger. And basically, if a bank's equity ratio falls below a certain level, which is normally 5.125%, the hybrid will be converted into equity or written off. And you need to be able to price the risk of that happening and work out what return do I need for that risk.